Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everybody, it's Nicole Benjamin, your host here at Seeking Alpha, to bring to you another episode of our new series, Portfolio Pulse, where, as the name suggests, we're going to be keeping a pulse to all the big financial moves happening in the market. Now, for today's episode, I am joined by none other than IG leader Daniel Jones, who's going to be helping us dive into all the things going on with YouTube, Google, Alphabet, all of that jazz. So without further ado, Daniel, thank you so much for joining us today.
Yes, thank you so much for having me. I'm very excited.
Awesome. Well, Daniel, I want to ask, you've been on Seeking Alpha since 2014. Tell us a little bit about how you got into the finance world, what your background is, your investment philosophy, anything of that nature that our audience might really love to hear.
Absolutely. So I am a value investor at heart. Very much following in the footsteps ideologically of Warren Buffett. I have something of a contrarian streak to me when it comes to my investment philosophy. It's funny. So when I was entering into college, I was actually planning to study physics. That was what I wanted to do. But that was in 2008. And we all know what happened back in 2008. Financial collapse started. At the time, I had what little money a high schooler would have tied up into an Edward Jones account. My parents actually also had some money tied in to that. And we didn't know anything about investing at the time. We ended up selling out at the bottom, which was literally the worst thing that you could have done. And unfortunately, that was financially painful. But it got me interested in the market. I started asking myself, well, if we can understand the stars in the sky, why can't we understand how our own economy works? So that created a lifelong passion for investing, and that's what I do now.
Well, let's jump in. You wrote an article on Seeking Alpha. Alphabet's YouTube is a behemoth that stands on its own. So for my first question, I want to ask, you've calculated that YouTube's standalone value could be as high as $490 billion. It's a lot of money.
Oh, yeah.
So why? Right. Me too. So why is it necessary that the value of a property like YouTube, be something to consider rather than just looking at Alphabet's total stock price value?
Yeah, absolutely. So when it comes to large conglomerates, and let's be honest, Alphabet is not just a search engine anymore. It stopped being that a long time ago. It is a technology conglomerate. It's necessary to do this sum of the parts analysis to understand how each important part of the company is valued on a standalone basis. And this is because, in part, the market often applies a conglomerate discount, if you will. And this is especially when, the divisions within the business have very different operations. And YouTube is indeed very different from the search part of the business, from the cloud part of the business, all of that. So valuing each segment individually helps to clarify what that intrinsic value is. It highlights the potential value that could be unlocked in the event of a spinoff. So if the company, for whatever reason, says, we don't want YouTube anymore, or we think it would be better on its own, it helps you to understand better what the whole pie is worth. It also helps investors to understand the regulatory risk. So big technology companies are under a greater risk of being broken up today or facing extreme restrictions than they probably ever have in the past. And regardless of what your view is on whether that's warranted or not, it it creates both a risk and an opportunity here. And by understanding what a company like YouTube would look like on a standalone basis, it helps you to understand better, am I paying a good price for Alphabet as a whole?
YouTube's share of the US TV market is at 10.6%. Now, how does that give Alphabet a competitive advantage against other companies that are, producing their own shows?
Yeah, absolutely. So when you really sit back and think about what YouTube is, it's not a traditional content provider. It is the largest content marketplace on the planet. So if you look at a competitor like Netflix, they control the entire creative output. They decide which shows that they're going to make, how they're going to air, when they're going to air. They cover all of the budget associated with it. And with that comes significant upside potential, but also it comes with execution risk, downside, all of that. YouTube doesn't have that because largely they are operating a variable creator driven content model. So they don't have to deal with the production costs. It's the individual YouTubers who have to deal with the production costs. They're the ones who have to deal with the risk. All that YouTube has to do at the end of the day is essentially optimize the ad and subscription experience, and then reward those contributors accordingly. So this ultimately reduces risk for the company and by extension its shareholders, and it improves the scalability of the platform.
Now, YouTube has 325 million paid subscriptions across its services. Now, with that in mind, what are the green flags that indicate that this growth is turning, free subscribers into a reliable stream of recurring cash flow?
Yeah, absolutely. So I would say that a really important green flag here would be continued investment into new or slightly different subscription offerings. So when you see YouTube Premium, you see YouTube investing in a marketing subscription, you see YouTube investing in live TV, things of that nature. That is definitely a green flag because it means that what they already currently have is proving to be successful. And what that translates to is additional customer stickiness. So if you have one subscription through YouTube, that's great. You're a valuable customer for them. But if you have 3 subscriptions, and especially when we extend this out to the subscriptions that exist that creators offer, when you extend this out to 5 or 10 or something like that, that means you're much less likely to leave the platform. It means that revenue predictions become easier. It means that the risk for the company becomes lower. So that to me would be the biggest, green flag.
Now, Daniel, I want to dive a bit deeper. You said stickiness, and it's actually a really great thing. But as far as YouTube, going into live TV, going into your NFLs, your Oscars, things of that nature, do you see this more as maybe just a steal of the market share itself, or is this more of a defensive play?
Honestly, it's both. So it's offensive in the respect that when you look at what is going on in the television space right now, anyways, cable is dying, people are engaging in cord cutting, and they are increasingly turning to streaming services and things of that nature instead. The company does see this as an opportunity to capture that market share during what will be really a one-time transition away from those traditional cable conglomerates into the new era of content consumption. But then it's also defensive in the respect that you have other companies right now in streaming that are investing in live TV, sports, things of that nature. So Disney's doing it, Netflix is doing it, and this is a threat to YouTube because if they don't have all of the best content, there is a risk that people will go over to Netflix, which is growing like a weed, or Disney, which is also growing rather nicely. So they want to do this also defensively because they want to still stay relevant and reduce that risk of that stickiness becoming less less of a of an asset for them.
Now, Alphabet just reported annual revenue that exceeds $400 billion dollars. And then again, they're spending $185 billion dollars on AI infrastructure. So with that in mind, are there any specific metrics like their EBITDA margins or YouTube's $60 billion dollars annual run rate that indicates, what the real story is behind the company's long-term health?
Yeah. So first off, I would like to say that the opportunity in the cloud market is definitely massive. Goldman Sachs estimates it'll grow from under $500 billion a couple of years ago to $2 trillion in global revenue for the industry by the year 2030. But so that's why they're investing so heavily, into this space. But in terms of Alphabet specifically, I would say that the most important metric is to look at operating cash flow after stripping out changes in working capital. And the reason why is that really gives an idea of the core health of the business. And it's what the company pays for these capital expenditures with. It's what it pays dividends, engages in share buybacks with, all of that stuff. Comes from this. So the fact of the matter is Alphabet has historically been a cash cow. It's historically grown rather rapidly. And by looking at what that cash flow situation is, you can have a better understanding of, okay, this is the fuel that it has for future growth and just to maintain stability too.
Makes sense to me. Now, my last question for you is, spinning off a successful asset, just unlocking a higher stock price, would you actually prefer to own YouTube specifically, or do you like it being a part of the company and that it's tucked within?
So there are certain benefits naturally to the company having YouTube stay with it. At the end of the day, Alphabet is a digital ecosystem, and they are able to cross-sell between different parts of the business. There's the opportunity for efficiencies there as well. However, from a purely valuation standpoint, it might make more sense for the company to spin off YouTube. And the reason why is, as I mentioned at the start of this, markets often discount conglomerates. This is because many of them are known for having inefficiencies from an operational standpoint. You have management teams that have different incentives. So you might have one management team that has all the best interests at heart for YouTube. But if Alphabet is committed to growing the cloud portion of the business, even if it means neglecting what could be a great amount of upside for YouTube, there's a discount that the market applies because of that. When you have companies spin off with a good management team, they are able to say, no, this is our business. Our whole business is growing YouTube, for instance. And that, typically the market will reward that in the form of trading multiple expansion, which can unlock immediate value upon a spinoff. So if it were at the right price, and again, this goes back to the whole, I'm a value investor, statement that I made at the beginning. If the price is right, I would prefer that YouTube be a standalone company. And that $490 billion valuation, like that the high end that I put in my article, it wouldn't be shocking if the company ended up being spun off for it to be worth more than that. I just think that that's the upper end of what's a realistic range without the market potentially overvaluing the company.
Well, let's leave things right there, Daniel. Thank you so much for joining us today. Everybody at home, make sure you go ahead, click the follow button on Daniel's page on Seeking Alpha. Check out Crude Value Insights, see if that might be the investing group for you. And also take a look into Alphabet, take a look into YouTube, see what those valuations are telling you and if that's right for your portfolio. And we'll see you here next time on Portfolio Pulse.